To trade successfully, it is important to keep a neutral, unbiased, and a clear state of mind. It's also equally important to stick to a clear set of rules and strategies. Have you ever considered how something as simple as color could affect your performance in trading? Let me explain. When you enter a long trade and the market moves against you, creating that red candle, you might start to focus on the downtick and become increasingly anxious. And this gets only worse as more red candles appear. This can have a serious effect on you, your brain, and your psychology, potentially harming your ability to trade effectively. Visual perception is a phenomenon in psychology that explains how our brains constantly look for patterns in trading. When you use multicolored candles, you may decrease your ability to be able to comprehend and to notice those patterns, as it decreases your ability to notice them because you're focusing on something else. Fast-moving red and green candles, as you can see behind me, have caused many traders, including myself, to take bad trades in the past, both on entries and on exits. To decrease your reactivity to price movements and to increase your pattern recognition skills, consider changing your candle patterns to one color. This way, you'll only follow the price within its range. Change the color to anything but red, and you'll most likely find yourself a bit more focused and calmer. As a trader, it's crucial to remain alert and patient. Successful traders wait for setups they have identified without being swayed by price fluctuations that may affect others. They conserve their energy and their focus only for those setups that they have prepared for, ignoring everything else. Instead of chasing the market, they let the market come to them. The opposite of this is forcing trades. When you see some activity, you may feel tempted to pull the trigger, but if you do it early, it's a recipe for disaster. Instead, what I recommend is, if you're struggling with this, use limit orders and let the market come to you. Once you've made your analysis, identify the places where you want to buy or sell, and then your goal is to buy and sell at the best price available. So, you should use your research to identify those price levels beforehand. This approach will result in better execution, and it'll help you avoid making trades based on emotions, reducing your stress and anxiety. So, maybe consider, instead of market orders, using limit orders. To further reduce stress and anxiety in trading, consider moving to higher time frames. This will give you the time to make informed decisions and the time to basically deal with the emotions and not rush into anything. When you're at the lower time frames, you're at risk of trading the market noise. The higher time frames may not offer trade setups as frequently, but the signals generated are much more reliable, and they have a much better chance of working out. It's better to take a handful of high-quality trades rather than trying to trade lots of poor quality ones. So, if you feel nervous and you're scared of losing money, maybe consider moving to a higher time frame. The transition may be difficult, and most traders are reluctant to make the switch. But changing your environment is necessary if you want to achieve better execution. Day trading is exciting, but it also requires monitoring the markets for many hours a day. Once your mental discipline runs out, your frustration, your anger, and all of your bad habits come out. That may take you to a dangerous state of mind that is really hard to come back from. So consider moving to higher time frames, spending just a portion of your time in front of the charts, and be at less risk of experiencing burnout. After a while, you may realize that it's actually much easier to keep a cool head when there's not a lot of pressure and not a lot of things happening at the same time, and you actually have a lot of time to think. One of the most frustrating scenarios that traders experience is when the price is coming in your direction, the trade setup looks great, but the price goes right to your stop loss before it goes to your take profit. Due to fear of losing money, many traders use stop losses that are way too small. By putting your stop loss too close to the opening of your trade, you're basically making sure that your account is going to get chopped up. By slightly widening your stop loss and reducing your position size, you're getting the trade room to breathe and allowing it to develop in your favor. This approach allows you to stay in the trade for longer, which means your chances of a profitable trade increase. You're also reducing the impact of your emotions on your trades, which is important because emotions can cloud your judgment and lead you to poor decision making. Another key element of having successful trades is having a good trading plan. A trading plan is a set of rules that you follow when you trade. We've made an entire video about it, you can check it out here. Your trading plan should be based on your trading style, your goals, and much more that I go over in that video. Creating a trading plan can be time consuming, but it's worth it. A trading plan plan will help you stay disciplined and focused, and it'll help you prevent making impulsive decisions. It'll also help you evaluating your trading performance so that you can identify areas for improvement. As a trader, it's easy to get caught up in the desire for perfection. You want the perfect entry point, the exact price that will guarantee a profitable trade. But this perfectionism can often lead to irrational behavior, overanalyzing and overthinking until your mental energy is completely drained. I know this from personal experience, as I have too battled with trying to find the perfect entry. Problem with waiting for the perfect entry is that you may miss out on big moves. You see an opportunity, but your fear of losing money and desire for perfectionism is what stops us from taking action. I've struggled with this plenty. You wait for the price to go down a few cents, then a few more, and before you know it, the price has gone up without you. To combat this anxiety and reduce stress, try using price ranges instead of exact prices. As a day trader, you can't monitor all the charts all the time, so give yourself some flexibility by setting price ranges. Of course, you'll need to be strict with yourself, but using ranges can help you avoid the perfectionism trap. Remember, perfection can be your worst enemy in trading. Don't let the desire for the perfect entry stop you from actually getting in and making profits. Use price ranges, stick to your trading plan, and trust your instincts. In addition to having a trading plan, it's just as important to have a trade journal. A trading journal is a log of all your trades, including the entry and exit points, the position sizes, etc., etc. When keeping a trading journal, it's important to be honest and objective. Don't try to justify losing trades or make excuses for poor performance. Instead, use your trading journal to learn from your mistakes and experience. Finally, it's important to surround yourself with supportive people who understand your goals and are willing to help you achieve them. Joining a trading community or finding a trading mentor can be invaluable. Not only can you learn from experienced traders, but you can also get emotional support and encouragement when you need it. And that's gonna be it from me. I hope you liked the video. If you did, don't forget to like it, share it, subscribe. And if you want to get in touch with us, feel free to message our 24/7 live chat or send us an email at info@luxtradingfriend.com. Mine has been Oliver. Thank you for watching and have a great one.